All right, we are live. Guys, welcome back to another episode of The Deep End. Happy Saturday or possibly Sunday, depending on where you're at. But hope everyone's having a great weekend. Thanks for tuning in with us for another episode, another live stream if you're watching on YouTube right now. I see that there's some questions here in the live chat. And by the way, guys, we're going to be going through your questions here during the episode. So if you have any investing questions, drop them for us in the chat. Kicking off with the first question, Ari. How are you, man? How are you? Let's kick it off with a good one.
I thought we were going to dive right into Chris's question, so you just threw me off.
Oh,
by asking me how I'm doing.
No, man, we got to exchange the pleasantries.
I was like, whoa, all right. Ryne, I'm doing well, man. I am really happy to report. You already know this because I already posted it on Blossom. Which, by the way, everybody listening, watching, whatever you're doing, we are powered up by Blossom. But if you're not already on Blossom, just want to say I highly recommend downloading Blossom, getting active on it. You don't only get to see Ryne's portfolio transparently shared in mine, but literally scores of investors who are sharing insights, their latest stock picks, and everything in between. So I can't recommend it enough. Regardless to say, I posted on Friday officially that I have surpassed a huge milestone, $400,000 in that particular brokerage account, which is huge, Ryne. So that's like the latest news. I'm very happy to report that we're not even in December, so I still got a little bit of time to enter into 2026 with even more. And thanks to the little run up that we had on Friday, I'm not just, a couple dollars above 400,000. I am now, as of this recording, $407,220 in that brokerage account. So that is like the latest update that I have that brings a smile to my face. I will pass this question back to you and see how you're doing. What's been up on your end?
Well, I'll get to me in a sec, man. A couple things that I want to say about hitting that milestone. And I messaged you this, I don't know when it was. I think whenever you told me the news. The crazy thing about getting to a portfolio of your size is that another 10% from here, just another 10% gain, which is like another standard S&P, 500 gain for a year. That's an extra $40,000. Just another 10% gain from here, you're going to be at $450,000 in the portfolio without having to lift a finger. And it could be as early as this time. Well, it could be even earlier, just considering what the market's done so far this year. But yeah, it's just crazy to think about how it really does start to reach this this sort of like escape velocity, to where these numbers grow to, at least from my point of view, these numbers start growing. The portfolio starts growing by what is really just like I don't want to call it unfathomable, but just a ridiculous number, like 40K gain. 50K gain is no joke. That's got to feel good, man.
That feels great, man. It really does. And you're right, man. Just a 10% gain. 10% gain is going to bring me another 40,000. So, yeah. And I run these numbers all the time. Excuse me here. I'm just playing with some lighting. I run these numbers all the time. And I just want to make sure it's bright enough. I feel like it's maybe it's not. Let me know in the chat if it's good, if it's not, whatever. But I run these numbers constantly, Ryne. Like I'm not worried about my portfolio in terms of reliability, sustainability, in that regard. I'm worried that I'm playing too small all the time. And the more I go at this, what I've discovered, and there was a post I made also on Blossom, of course, when I posted this feed that I crossed that $400,000 mark, that still it's like playing too small. I had reached out to someone in my network that I have come to really know and enjoy conversations with. He's a hedge fund manager, or was previously a hedge fund manager, and we had a good conversation around this. But my reality is I still feel like I'm playing too small, especially when I spoke to him. And we're going to see some big things in 2026, at least on my end. So stay tuned.
Well, if you don't, I just want to say,
when I run the numbers on,
if we don't see some big moves from you in 2026, you're grounded, my friend. You're in big trouble. So just so you know.
I'm gonna quit. I'm just gonna quit YouTube. You
Sorry, I
won't
didn't.
see my face here anymore.
Yeah,
Or
my
you
bad,
just
man.
you could be I'll be replaced by like some AI bot, man.
I didn't mean to cut you off. I just had to work in one of my lame jokes. So continue on.
Dad, a dad joke, literally
Seriously.
now.
Yeah.
Um, I will say this, running these numbers, when I run it on a million, that's when I begin to say like, holy smokes. This is
Okay.
also why I say milestones as quickly as you can. Enjoy the journey, but hit milestones as quickly as you can. Like, I created that Blossom post, and I know I'm intense. I think I'm very intense for too many people, but I'm not intense enough for myself. That's just how I like to play in the sandbox, right? That's what makes me happy. Being intense and going all in. But I love the process. I love the process of intensity. I love the process of hitting my goals, and I love everything about how I'm currently working and rolling. So yeah, I'll share that. Right. I'm going to be impressed once that 7-figure club number hits, because 10% of a million. Think about that. Some people, yes, 10% of what I have now, the 400,000 is impressive enough. At 40,000, that's at least that's basically one person's salary on average in the States, right? But
Mhm.
now
Yeah.
10% of the million, they're on their fourth, right? It's crazy.
Yeah, it is crazy. Crazy, man. That's the magical thing about compounding. And it's those early reps, it's building up to that point that is really the tough part. But it is cool to see it kind of grow some legs and start running on itself. Um or running itself up, I should say. Once you get kind of to the point where you're at. But anyway, as far as my portfolio goes, man, we're sitting at all-time highs. I think right now I'm at about 100, just under $118,000. So pretty cool. I definitely think at this rate we'll see easily $120,000 in the portfolio by the end of December. We may possibly get to that 125. I got to look at the finances and see what things are look like, but I may do some more heavy contributing in December. On that note, I am proud to say that I think that we've hit that $4,000 annual dividend income goal. So over on Blossom, actually, it'll as part of the portfolio tracking features over there. You guys will know this if you're on Blossom. You'll see it if you get on Blossom. But over there, it'll show like your dividend income, your projected annual income, and you can even set goals too. So like I have my income goal set for $4,800. That's like the next big milestone in my mind. And it tells me on there that I'm sitting at $4,060 in projected annual income, which means we'll have surpassed that $4,000 mark. And I think that puts me at something like 84% of that $4,800 goal. So that's really cool. However, over on Snowball Analytics, it's a bit lower. I'm sitting at the projected income sitting at $3,999.23. So we're like right on the fringe there. But and I want to use that more conservative number just to be more conservative. But yeah, we're pretty much there, and that feels good. So things are good in the
That's
portfolio, is what I'm
amazing.
trying to say.
We've both done it by this point. Our goals that we've been talking about over the last few weeks, we've both been mentioning these milestones, and here we are. I always look at it, in terms of, well, how much time left is on the clock, and we did it, a whole month more plus shy of
Yeah.
the new year.
Yeah. Yeah, it feels good, man. And it'll be, it'll be interesting to see what this next month brings. I don't know. Um, yeah, it'll be interesting to see how we close out this year. Feels like it's really it always feels like this kind of once you get to the end of the year, but man, it feels like 2025 just flew right on by. You know what I mean? It's like you blink and it's gone.
I was honestly just thinking about that, today. Time really does go by. Here's a question for you though, because because you surpassed your goal, the 400,000 there in divvy income. Are you going to lax up a little bit for this last do you think, or you're gonna go full pedal to the metal?
Yeah, I'm still going full pedal to the metal. I really want to see I need to see what finances look like after my bills. I also need to think about Christmas coming up. And actually, I'll pick your brain on this. Pick all of your guys' brain. We're going to have another watch conversation. So, I you know, we had this big watch conversation a few weeks ago about the Breitling Top Time B31. I decided I'm not going to do that, and I feel good about that decision. But one of the other things that I've been wanting to do is I've been wanting to buy my wife a nice watch, and we have one picked out. It's a Cartier Panther. It's like the small size, really nice. We actually tried it on, or she actually tried it on yesterday. We were down for Black Friday. We went down to the Forum Shops at Caesar's Palace, which was packed, by the way, and just walked around and browsed through the shops. And we went into the watch shop, and she tried on, this one Cartier watch, and it was the one. Like when the time comes, that's going to be the one. And so I'm kind of thinking, should I just do something like really big and something really nice and surprise her with this watch for Christmas? On one hand, I think that would be epic. I that would be such a nice thing to do, and I would love to do that. I honestly, when I think about buying a watch, it's bringing me more joy to think about buying her this watch than it is to think about myself. It's more stressful to think about myself buying that watch that we were talking about a few weeks ago. And so I'm thinking, and this is an inevitable thing too. I'm going to buy this watch for her at some point. It's my goal. And so I'm thinking, can now just be the time to do it? Should I just buy this watch? It's perfect. We tried it on yesterday, or she did. Price wise, it's maybe about $5,000. So maybe figure $5,500 with tax when it's all said and done, maybe a little bit less. Which obviously would cut into money that could go towards investing. Um, but I don't know. I'm really trying to weigh. This is a very similar conversation as what we had a few weeks ago. I'm really trying to weigh this back and forth, doing this thing versus like saving and spending that money versus saving this money, maybe putting it into the portfolio and doing something else for Christmas. And my wife's not here, so she can't hear me talking about this. And I doubt she's watching this. Well, I don't know. She always surprises me, so I don't think she's watching this though. But I'm really thinking about doing that. What do you think? Is that and let me know in the chat too, guys. Is this a good move? What do you think?
I was gonna say a bold move mentioning it live, because maybe
not
she is
watch it.
listening. Who knows, man? Who knows? And if she is, well, now she knows what she's very likely to get. But yeah, so act surprised, surprised if
Yeah.
you are. But what my thoughts? First of all, as we all know, a happy wife is a happy life. So there's that element. But I also think that she just gifted you with $1 billion with your newborn.
Yeah, that's
And
true.
the way I kind of see it is, what's $5,000 compared to the billions that she gifted you with. And so that's kind of how I would look at it. And I have the same reaction, right, that I do with when you wanted your watch, man. It's like, do it, buy it.
Yeah, I think the more I think about it, the more I think I want to do it. Like I said, it's an inevitable thing. Like this is something I really want to do for her. She really is excited about it. And I thought it would be a fun way to commemorate a few things. Number one, it's obviously a nice Christmas gift. We can make like a nice evening out of it. We can go have a nice dinner. Well, we can go get the watch and have a nice dinner afterwards. So we can make a fun night out of it. And also, yeah, kind of like you said, it's kind of a nice way to commemorate. This is like the baby watch, this is like to commemorate the baby. And at some point down the road, the thing about watches, or the thing about this particular watch too, is it's a very timeless piece. This has been, I mean, this particular style of watch has been, popular. It's been in style, I should say. Probably, I don't know when they first started making these, but I think it's been close to 100 years, if it's not already 100 years. Maybe it's not 100 years, but it's a long, long time that this watch has been around. So it's timeless. And so down the road, when our baby gets older, it could be something that gets passed down to her too. And so I'm thinking about it that way as well. It's kind of a multi-generational piece.
Yeah, I mean, I don't ever see anything wrong with, spending on yourself, especially after you hit milestones. because
Mhm.
once you hit your milestones, it's just like you deserve something. And honestly, I would say, because we all know you, Ryne, but your wife, I mean, she's probably going through more of a trip with you, doubling down on savings and hit these financial goals on behalf of the family. It's for everybody, but it's not easy to live with someone, who's frugal and money minded, right? Because I mean, just think about it. We're constantly thinking about, let's invest,
Yeah,
right? And
I know.
yes, people see the importance of it, but not like us.
Yeah. Yeah, it's such a hard thing, and I know we've talked about this so many times. It's such a hard thing to get over, the opportunity cost of what that dollar could turn into. And selfishly, it feels good putting that in the portfolio, seeing the value of the portfolio going up, but also seeing the passive income going up. Um, but I don't know. At the end of the day, like I guess it is all about balance, and I don't know. I think now would be a good opportunity to try and strike more of a balance in the other direction, especially like coming out of this month, out of November. I invested this month. I did something for me this month. I invested more money than I think I ever have in a 1 month period, um, which felt really good. I want to do it again in December, but balance, right? So I don't know, and I think it would be, like I said, I think it would be a great gift. I think it'd be a really special thing to do. And yeah, it's obviously the baby's been a blessing for sure. And it's been a lot of fun. But it's also not been it's there's been times where it hasn't been too easy and it's been stressful for sure. And so I think that would also be a nice thing to do in that regard. Here's something for all your troubles.
Yeah, look, I also think it speaks volumes because, if she has a deep appreciation, which I think she does, for you and what you're doing, then she would easily recognize just how much money that costs and what that means to you. Because again, when your partner really recognizes, the things that you do and appreciates the thing that you do, once you don't do that thing on behalf of that person, whatever. And I want to say just investing, it could be anything. Like if you're a huge football fan and you decide that instead of watching a Sunday football game, that you're going to, take your significant other out on a date or spend your time elsewhere, your partner better recognize, or should be able to recognize, just how important the thing that you missed is, and the efforts that you're putting into it. So, man, like I said, I really think it's a great idea, and I definitely think she's deserving of it. The two of you, I mean, I love it. I love the both of you. You guys are great. All three of you.
Okay,
Fire
well,
the
I think
watch. I'm team watch.
okay, I think it's honestly I know I said this a couple weeks ago when we were talking about the other watch, but as far as this one goes, I think it's decided. I think I'm going to do it. I'll do it. I'm going to commit to it right here. That's what I'm going to do. Gosh, I hope she's not watching. I
That's a
hope she's
commit.
not watching. Uh,
Yeah, hopefully she's not. But if she is, just act surprised anyways. That's all you have to do.
well, I will say, like, it feels good. It feels good saying it out loud and being able to, come to a conclusion on it. And it looks like all of you guys in the chat are supportive of it. Let's see. Patron here says, my personal opinion is the watch would be a great idea. Savor the skies is a great point. A good way to look at it is your next year's dividend pretty much pays for it. Yeah, absolutely. Fast Eddie says, would you rather have a purse or would she rather have a purse? She has a nice purse, actually. She's got a couple
Ryan would
nice
rather have
purses.
the
So
purse.
I'd rather have the purse. Yeah. No, but it feels good to come to a conclusive decision on it. It's so tough, man. It's always so
Hey,
tough.
can we just get a hot take while on the topic of a purse? I want to ask this to you. It's nothing to do with investing or personal finance or
Okay.
anything like that. But you ever see a man with the like the
Yes.
fanny pack, like what is it, merch? Is that what we're
Yeah, no,
calling it?
it's no, you're right. It's like, well, we would growing up in the 90s, we'd call it a fanny pack. These days
Yes,
there's a
but
different name for it. It's
it's a man purse. It's a merch or
like a
something like that, right?
sling. I don't know. There's some name for it that I don't remember. But
What
anyway,
are
I
your
still call it a
thoughts?
I don't like it. It's not really for me. I don't really get I don't really get it. It's just a trend that will pass. I think we're already
Hopefully.
seeing it pass. I do. With that said, though, I do like the idea of having something to carry things so I don't have to put them in my pocket. I don't really like having my wallet or my phone or my keys in my pocket just because it always feels so bulky carrying it around. But so I do think it's nice, but as far as the look goes, I don't know. I don't want to be caught carrying that stuff. With that said, though, I do know some friends here in Vegas who religiously carry them, but it's because they have their concealed carry permit. So in there, they usually keep their 9mm or whatever.
That's so
Um,
different.
Totally different. Yeah, but it looks the same. Like it's designed so you would think it's just a normal fanny pack thing or whatever. So anyway,
Yeah, man, that's so different. If you're carrying like concealed, that I wouldn't
yeah,
even call that. Someone mentioned that their Midway Piper a Merce. Thank you.
immerse.
I wouldn't even
Yeah,
call that a Merce. That's like concealed carry. But yeah, I hope it's a trend that just passes very quickly. I don't understand it. I also, for the life of me, can't figure out what the heck guys are even putting in there. Right? Like, I don't know about anybody else. You got a phone and your wallet which has credit cards. I don't even carry cash, like credit cards ID.
yeah,
That's
yeah.
it. Like, how much are we really carrying these days? Dangerous
Yeah, I
question.
don't know. Midway says it's a European thing. I see it all the time here in the States too. Especially here in Vegas down on the strip where people come from all over the country and all over the world. Real quick though, a little donation for Team Watch. Is that euro? €2.
Two
So thank you so much
euros.
for the super chat. That's really nice. And I have to do it now. We got the $2 or the €2 super chat. So
He's invested, man.
yeah, okay, we're doing it. We're
I
doing
hope
it.
when
And
you give her the watch and there's a card that goes, I don't know if you're a card guy. I would usually gift a gift and a card, right? But whatever. If there's a card, Ryne, it better say that $2 out of that came from a deep
yeah,
end listener.
yeah.
It's no longer
But
just from you.
that's a good question. What do people even carry in there? I'd imagine it's a phone, keys, wallet. I don't know. I don't know what else. What else does a guy need? Maybe a pocket
next
knife.
time
I
I
don't know who carries pocket knives these days, but
next time I see someone wearing it, I'm gonna ask, what are you carrying in there? What are you
oh, here we go. El Patron, another $10 super chat, another donation for
All
Team
right,
Watch.
your gift better have signatures from all of these individuals.
Yeah.
So I'm just and if you don't give them credit, man, I'm calling your wife up. Say that wasn't just Ryne.
No, it was the
The
deep end
deep end
chat.
gang.
It was a team effort. Yeah, Chris here says chapstick as well. Yeah, got to have the bag for the chapstick, I guess. But yeah, I don't know. Like I said, it's just I understand the practicality of it, but aesthetically, I'm good. I'd rather just keep things in my pocket. Maybe that's weird. Man covers, Fast Eddie said, yeah. Anyway, man, should we jump over to some of these questions? I think we've got
Yeah, let's get to some of these
3
questions.
saved so far. Yeah, so let's kick it off with Chris's question here. This one came in before the stream actually started, but Chris says, Ari, if you could pick one stock from Ryan's portfolio and eliminate it, which one would it be? And which stocks
Oh,
would you replace it with? Ryan, the same
first of
question for
all,
you for Ari.
I thought actually I read through this question very quickly and I misread it. And I thought it was just saying which stock would I invest in from Ryan's portfolio. And I was like, oh, it's going to totally cramp my style.
Oh,
But I was like, I'm on a roll right now. And now you want me to buck out of what I'm doing and pick a dividend stock. Wow. And eliminate it. That's also kind of hard because Ryne has good picks.
thank you.
Ryne, can you do me a favor and just like very quickly run down your entire portfolio?
Sure, I will. And I kind of think I know once I list them, I kind of think I know which one you'd get rid of. It's actually between maybe two different ones. So I'll just run down the list name by name. First and foremost, we have AbbVie, we have Chevron, we have Enterprise Products Partners, which is a midstream, energy company, pipeline company. Johnson and Johnson, Kilroy Realty Corporation, we have Lowe's, we have Main Street Capital Corporation, Realty Income, Blue Owl Capital Corporation, Procter & Gamble, Snap-on, Visa, Vici Properties, WP Carey, Williams-Sonoma, Watsco, Clear Secure, and Zoetis.
Man, this is a very hard question. I'm not frozen. I'm just thinking, man, this is hard to eliminate. Wow.
I think it's between, I think there's maybe, I have two in mind that I think you'll say.
Well, it's hard. So my mind, I'm trying to think like Ryne. Maybe that's the problem. As I'm like, if I put myself in your shoes, which one? But this perhaps is just like, which one would I want to get rid of, right?
Yeah, do it from your perspective. Like hearing that list, like which one to you seems like probably the weakest link in the portfolio. That's how I would think about it, at least. Yeah, that's how I would think about it. And part of it's tough too. Part of it's tough too, because I don't expect you to know like all these companies and what they do. Anyway, but what did you say? I'm sorry.
No, I'm just trying to think like, man, this is so tough. This is the hardest question I think I've ever been asked on the deep end.
Yeah, it's a tough one.
But it's a great question.
And also, this probably goes without saying, but don't worry about hurting my feelings. Don't worry about that.
I think I'm gonna.
Yeah, El Patron says, Ryan, quickly buy a share of MPW so Ari can choose it and not think about it. There you go.
Ryne, I think I'm gonna surprise you with my answer. Actually,
okay.
I think I would boot Realty Income.
Okay, that was not one of my two.
But let me give you the rationale as to why.
Okay.
So a real estate play, is going to be obviously geared towards income generation. But also I feel that Realty Income has kind of reached a peak for itself. I mean, it's a behemoth. It's a very, very stable paying, dividend company. But we're asking which one would I boot and what would I replace it with? And so based on the other stocks in your portfolio, there tend to be there's more growth orientation with the other picks there versus Realty Income. Also based on just interest rates, right? There's a lot that goes into a REIT. But I'm thinking just about our macroeconomic conditions right now. I'm thinking about interest rates. I'm thinking about how it's performed over the last couple of years. I personally haven't been impressed with it. And then I'm also factoring in investor profile, right? So the necessity for the generation of 4+% income right now, right? It doesn't make sense to me. So I would boot it. I'm sure that surprised you.
Yeah.
But I would easily replace it with Alphabet.
Okay. No, I think your reasoning makes sense. And you're definitely not the only one who thinks that about Realty Income. So I think that's totally fair. I thought that you would have said either Procter and Gamble for a similar reason as Realty Income, just maybe, not having as much growth or just being, too much of a stalwart. I would have thought either Procter and Gamble or I would have thought Blue Owl Capital Corporation. For some reason that those two jumped out to me.
I was gonna say Procter and Gamble at first.
Okay.
But here's the difference between Procter and Gamble, in my opinion, everybody, in my opinion, not investment advice, always do your due diligence on your own picks. But my opinion here is that there's still growth in Procter and Gamble. It's not like crazy growth, right? But it's a very reliable stock. Obviously, their products are to be bought in upswings and downswings in the market. But if you look at Realty Income, it trades sideways, especially as it has been for quite some time. So I feel that Procter and Gamble as a long-term bet, it's kind of like, it reminds me of like a Coca-Cola, right? There's nominal growth, but growth nonetheless.
Yeah. Yeah, that's fair. And that's kind of how I look at Procter and Gamble too. It is growing, albeit it's just not growing as fast as certainly some other companies out there. But that's kind of what you get in the consumer staples sector. And I will say, as far as realty income, they are still growing too. They are still growing their FFO and stuff like that. But it's tough. It's getting tough. I don't want to say it's getting tough, but the company's changing. Like they are, because of their size, they're forced from going from this, pure play triple net retail REIT to now expanding into other avenues. That's why we've seen them kind of dip their toe into gaming a little bit.
Vegas.
Yeah, with the Win and also their stake in the Bellagio, but also now like kind of getting into more lending type stuff. So the company is going through a transition in an attempt to continue growing. I don't, I personally think that's fine. Um, I don't really have an issue with it. I think some others might, if you get away from your bread and butter, there's risks involved with that. But I think realty income will still be okay, and I hope that the growth does work out in their favor. But in the meantime, still getting that growing passive income. Occupancy is still incredibly high, still like 97,
90.
98%, something like that. And I don't expect that to change. So I do think it is if we see something crazy happen, I think it will help hold up my portfolio. So I do like it in that regard. But I still think your reasoning makes sense. What was I going to say? I think there was
Look,
no. I
if
think that was
you
pretty
if our investor profiles were different, if me and you were like in our 60s and someone asked that question, then that wouldn't be the case. I wouldn't get rid of it. But like, I'm going based off of right now, so our investor profiles right now, do we need this income right now? What's growing slower? So there's a multitude of factors there. And that's also just another important aspect to this question that everybody should be thinking about for their own portfolios, which reminds me now, this would be a fun game for each and every one of us to play on our own portfolios. If we were to take an objective, approach to looking at our portfolios, which ones would we boot out? And then once you have that answer, I hope you proceed to boot that stock out and keep moving forward.
Yeah, I've done that a few times. And that's to, kind of to your point about Coca-Cola earlier. That's one of the things that led me to sell out of Coca-Cola a while back. And actually, as I'm looking at this, while we're on the subject, I actually think, interestingly, Coca-Cola is, yeah, it's $10 above where I sold it. I mean, I still locked in a pretty nice gain, but still, interestingly, if I would have held on to it, I would have seen greater returns than from where I sold it. I don't remember exactly what I sold out of Coca-Cola for, though. Maybe Vici or something like that. I don't quite remember. But anyway, now I want to answer it for your portfolio. So if I had to get rid of one stock from your portfolio, and I'm trying to remember, so I know you, just as far as I wouldn't touch the ETFs. Why would I? So as far as the individual picks, there's Meta, there's Alphabet, there's Nvidia, there's Tesla. Is that it, or is there one more that I'm missing?
Yeah, there's Alphabet. I'm sorry. Alphabet, Apple, Amazon,
Apple.
Tesla,
Amazon.
United Health, Meta,
United
and
Health.
Nvidia.
Which one do you think I would get rid of?
I feel like you would probably boot either Meta or Tesla.
It would probably be Tesla, for the sole fact that it just doesn't pay a dividend. I actually think Meta is a great investment. I think I guess based on my argument for Tesla, that also would maybe make me want to look towards Amazon. But no, I'd sooner boot Tesla. But even that, dude, this is why it's such a tough question, because even when it comes to Tesla, I still see the merits for it as an investment. I mean, I don't know a single person, to be completely fair. I don't know a single person who owns a Tesla that does not love it. My little brother just bought one, and he's absolutely in love with it. He actually said, we were texting about this yesterday. He actually said, I may be a Tesla lifer. So you're seeing a very interesting thing going on with Tesla, where people are it's kind of like an iPhone. If you're an iPhone person, you're an iPhone person. It's gonna take a lot for you to switch to something other than an iPhone. And from what I've gathered from Tesla owners, that there seems to be a similar way of thinking there. People who own them absolutely love them. And also think that the self-driving thing is very interesting. You know, the whole robo-taxi idea. I think that's very interesting. I think the robotic side is really interesting too. So, you know, even with Tesla, I'd be pretty hesitant to sell out of it. And I don't know, but process of elimination, that's probably the one that I would go with first. I mean, company aside, it's probably one of the more volatile stocks. Not that that makes it bad, but that's another thing that I personally wouldn't want to deal with. So I don't really know. It's such a hard question. Really? I mean, I just wouldn't touch your portfolio. I think it's fine. If I had a gun to my head, I'd have to say Tesla. But my reasoning for it, I don't think is that good.
You know, it's funny because I want everybody to realize whether I was answering or Ryne was answering that it was a challenge. It really like to actually think about which one to boot out. And I want to say it's because you're within our portfolios, we do have quality companies that are in there. And so this exercise would be a great exercise. You know what would be really cool actually? If people in the chat would actually ping each other or like somehow get in touch with each other to do this exercise. And because it really does make you think critically about your own portfolio. And this is something that, you know, more recently, Ryne, I know you do these, you know, portfolio reviews on Instagram. I don't know if you also put them on YouTube, but I know they're on
Yeah.
Instagram. And I call Ryne the playground bully because you're always somehow picking people with like who are like 14 years old, and you're like, this portfolio sucks. No, no, it's not always like that, but it's a great exercise that I do actually with for example, the hedge fund manager, right? I'm like, hey, like here's my rationale on a certain stock. My rationale, I was just had a latest conversation on United Health. And I said, you know, what do you think about my rationale here? And this is just such a great exercise. You know, find somebody who's equally as jazzed up about investing and equally as capable of sizing up your portfolio and talking in depth about investment decisions with you to put an objective lens on your portfolio and hash out perhaps what positions aren't serving you anymore, because you can easily sell out of those positions, reallocate that capital into a higher conviction stock. And I don't guarantee a lot, but I'm going to guarantee everybody this: you will be more satisfied with your portfolio. You'll be happier with your decision, and very likely have more money because that higher conviction pick of yours will ultimately lead you to more riches along the way.
Yeah.
Hopefully, if it's a good pick.
Yeah. I couldn't agree more with that, man. When I'm doing these portfolio reviews, one of the most common things that I see, and I would say this is actually like the basis for all of my reviews because it's so prevalent, is I commonly see one of two things. Number one, I see like a lot of overlap just between funds, or like having funds and then the individual companies are like the top positions in the ETFs that they already own. And sometimes they have like duplicates of the ETF. And so I see a lot of double dipping going on there. That's something that I think is pretty prevalent, which does make it pretty easy to trim. Because if you have exposure to something here, you don't necessarily need it over there. I mean, it's not going to kill you to do it, but that is one thing I see. But then another thing that I see on top of that, and this is maybe even more prevalent, is just a lot of positions that are, you know, 0.2, 0.3, 0.7% of one's portfolio. Really, really small, and I would argue kind of meaningless positions. I think when you have positions that get to be about, you know, 1.5 or 1% of a portfolio or less, you really don't need them, especially if you have a smaller portfolio. They're really not going to move the needle for you in any substantial way. And if they're individual companies, I mean, especially if they're ETFs, you don't need to have like 0.5% in an ETF. I just don't see the point in that. But even if they're individual companies, like that's still a company you have to keep up with. And so you're going to be spending a lot of time on something that really doesn't make a difference for your portfolio. And I just think from a time management point of view, and just based on our limited attention spans, I just don't think it's doing you any favors.
Yeah, I love that, man. I agree. And, it's just looking at the chat actually here, I'm pretty impressed that Fast Eddie throughout his portfolio and
Yeah,
is
let's pull it up
asking
here. Let's
you
check it
for
out.
him. Just before we actually answer this question, Eddie, do you mind just giving us, or at least me, just like objectively where you're at in life, maybe a little bit, just a little bit more context here, or at least just your age? You could ballpark that if you want as well, but that would just help me. Or are we doing the same thing? Like, because for me, it's hard to do this because with Ryne, it was a little easier because I'm like, Ryne and I are the same age, same timelines. But with this, it's like you always got to be careful. So, but then if this were my portfolio, is that how we're playing this, Ryne?
Well, no, I think it's kind of the same approach as like we answered it for each other. But see, like when I do these portfolio reviews, sometimes I don't get the context either. So what I'm doing is, once again, I'm looking at the position weighting in the portfolio, and then I'm looking at the companies themselves. Like, are there objectively any kind of low quality businesses in here? If we're talking about businesses, and that's kind of the low hanging fruit that I start with. Are there any small positions? Are there any kind of bad businesses? Or even just like looking at this list, Apple, AMD, Berkshire, Palantir, SoFi, whatever, all the way down. You know, are there some that really just don't seem to be as high quality as the others? Sometimes you can tell. This is kind of a tough list though, because even, a lot of these are all pretty solid companies. I mean, my eye is immediately drawn to like the Palantirs and SoFis, not necessarily because they're bad, but buying into, really hyped up momentum driven companies just scares me.
But check this out. He responded in the chat, 62 years old. Now, does it scare you even more?
Only 20K in Roth, 2 million in retirement. Going back to the list. Yeah. I mean, I think that also makes me a bit more concerned when it comes to having companies like Palantir or SoFi. Yeah, really those, maybe possibly AMD too, but it also depends when you bought them. Like it depends what that position looks like. If you're up a whole bunch, then that's not as big of a deal as it would be if you just started your position in Palantir and SoFi or AMD.
Yeah, I'm with you on the SoFi and Palantir. It would be one of those two.
Mm-hmm.
AMD doesn't concern me as much, just because given the space that it's in, and I don't want to say it's not as volatile. I mean, it can be volatile depending on the times and headlines and whatnot. But I think Palantir and I think I would go towards Palantir, man.
Yeah, I probably would too. Oh, okay, here we go. He's up 865% on Palantir. So now's not a bad time to maybe lock in some gains then. I don't know. But then there's the matter of taxes. But at the same time, like you're gonna have to sell that stock at some point. And I don't know. That's when it gets tricky because you don't know what it's going to do from here. You are more reliant on the share price returns. You don't have as much time for them to continue going up before you need to use those investments. So I think those are all things that make investing in these kinds of stocks tricky, but it's worked out well for you so far.
Yeah, look, man, I would say there's a point in a time when you have to transition. And I always like to say that it's pretty wise to start transitioning your entire portfolio a few years before, because that means lock in your wins, and at some point or another, unless you're Ryne living in Vegas, you got to leave Vegas. Like,
Yeah.
You got to leave because it can get dangerous, right? Palantir, you might be doing great on it right now, but some of these more volatile picks, again, depending on market conditions and systematic risk, like anything can happen. So because of the timeline, that's what scares me the most. It's not the company itself that scares me. It's what could happen in the amount of time that you have left that scares me.
Mm-hmm. Yeah, well said, man. It's cool. Like some people, some other people are dropping their portfolios. This is kind of cool to see.
Yeah, right. It is. It's I'm looking now. We have the other one there.
Right here
From yeah.
from Tony Baloney.
And I think he said he was 22 up there. If I'm
Yeah, I
not
think so.
mistaken. So
Yeah,
this is cool
22.
because it's the total end of the other end.
Yeah. So we've got Visa, we've got Meta, Google, SPGI, MCO. That's Moody's, I think, right? I don't know what VITL is, and then ASML. And most everything, I mean, Visa, Meta, Alphabet are all 20% of the portfolio, 8% in SPGI, which is S&P Global, 8% in Moody's, 5% in VITL and ASML, and then 5% cash. Yeah, these are all really high quality companies.
VITL, is that?
Yeah, what is that?
It's a Vital Farms, an American egg and butter brand founded.
Uh,
Do I have that right?
yeah, Vital Farms. Exactly. I don't know.
I don't know
Probably
that one. I don't know
just,
why. Like it's, um, this
I
is
will
an
say it
interesting.
looks like it's I'm looking at the income statement right now. Really killer revenue growth. Looks like they just recently became profitable a few years ago. Really solid net income growth. So it's a younger company in a definitely like early on in its life cycle, definitely in the growth stage. So um doesn't the financials don't look bad.
Oh, that's really cool though. He did comment there. Vital Farms is the eggs I always get from Whole Foods. That's an awesome way to go about finding a stock.
Yeah.
That is very Peter Lynch-esque of you, my friend. So for that, I applaud you.
So yeah, that's a tough one too. I mean, I'm
This
kind
is
of
not as
drawn.
tough for me, dude.
Okay, what would you say?
Um, I don't like Vital Farms for a 22-year-old. I have a issue with Moody's.
Okay.
I think it would be one of those two for me.
I see. I was probably going to go with Moody's as well, just for the fact that I think them and S&P Global do pretty similar things, and I would kind of liken it to owning both Visa and Mastercard. I don't think you need to do that, and I'm kind of applying a similar thought process to S&P Global and Moody's. I think you'd be fine with just one of those two, um, and I haven't looked into either of them enough to know which one is the better. But from what I do remember, S&P Global's financials are really solid. I'm sure Moody's is too.
I'd like to see this portfolio a little bit more aligned with investor profile wise, some more risk. That's what I'd like to see. I also don't
But
necessarily love the 5% cash position unless you're really trying to hold out to time the market in some way. But how did that work out for you this year? And I don't mean to like
mhm,
like throw you under the bus, but I say that because I made a mistake the other year, right? It was like I'm waiting. I had all this cash. I was holding out for something big, glorious event to invest in. By the end of the year, I was like, well, holy crap, I still got $30,000 just sitting here in my settlement fund. So for me, it's just like invest the cash. Don't worry too much when you're young about trying to time the market. You never should try to time the market, but if you're young, I mean, just throw it in.
well, I think that's kind of that kind of brings us to the next two questions. They're kind of similar in a sense. But this next one is from Savor the Skies, who says, Ari, kind of on that note of timing the market, are you still buying the tech ETF despite the fears of an AI bubble? What are your thoughts on that subject?
It's a great question. This one came up earlier. I saw it up there in the chat, and I actually really appreciate this question. I am definitely still buying. I believe that we are, of course, in some type of bubble when it comes to the tech space here and AI, and we're seeing that actually play out in ripples right now. But I am not scared in the slightest. I am optimistic about technology well into the future. I believe, truthfully, anybody that doesn't have their hands in tech needs to get into tech in some way, shape, or form, because this to me is like still the infancy stage of technology. If people are right now think like this is it, like the future has just begun. It's happening right before our eyes right now. And with AI and quantum, which I've been, of course, just had to become more well versed in over the past year now. It's crazy, man. I really am gun ho about tech in the sense that like this is the infancy stage. I think people don't really understand just how powerful these technologies are going to be for us. So I like tech, and it doesn't scare me away, depending on the investments that someone would invest into. So I am still investing heavily into my positions that deal in tech. If an AI bubble hits, I believe it will be very short-lived. I believe it will be a scare. Like, just think back to 2020 for a split second. That was, believe it or not, one of the fastest market recoveries ever. And I believe that we would see something, again, it's anybody's guess. This is my own opinion. We would see such a rapid recovery just by nature of where we're heading technology-wise. And everybody knows we're in a bubble and feels like we're in a bubble. So ultimately the bubble would burst, and it would be fear that's going to drive the hell out of people to sell. And then I think we would very quickly see a lot of savvy investors, sophisticated investors capitalize on that opportunity. And I'll be one of them.
Yeah, well, it seems like, I don't want to call it a no-brainer, but it would seem like a pretty easy decision to buy companies like Meta or Alphabet or what's another one? Even Microsoft. If stuff were to hit the fan and those stocks saw a pretty tremendous downturn in share price, it seems like it'd be pretty obvious to swoop up those, because they're printing so much cash and their balance sheets are all so clean that, like I said, it seems like kind of an easy decision to buy the dip on those. Especially now, like now that they pay a dividend, you're going to get a higher yield then than you definitely would today. And so I think it's pretty easy, but at the same time, I think that's maybe one of the growing concerns about a lot of stocks in that space, is because they are investing so much into, building out all this AI infrastructure. They're kind of transitioning from being these like high cash flow generating capital light businesses to now being a lot more capital intensive, and reducing the amount of, free cash flow they have after all that capex. And so it does kind of seem like, possibly, at least in the interim while this is all being built out, it seems like maybe the nature of those businesses are changing, which I think scares some people. But at the same time, and I think we kind of talked about this last week, which, by the way, speaking of last week conversation, I went back and rewatched part of it. This was when I was at Newport Beach. Oh my gosh, the sound was horrible on my end. So I want to apologize for all of you guys who listened to last week's conversation. I hope to never do that to you again. But I, like I said, I think that's one of the growing concerns with these companies, but it's necessary, right? Like, how else is all of this stuff going to be brought to fruition if these companies that have the cash to do so aren't investing in them? It's there's not really any way to get around it. So it's kind of an interesting time to invest in those types of companies. It'll be interesting to see what the next couple of years looks like for them.
Yeah, I think there's a lot of runway, in this sector, the tech sector. And I think we would, again, like I said, I think we'd be foolish to think that this is it. And even if tech crashes, it won't come back, or like there are companies that are so fun to the direction in which we are heading, and pioneering the future. So just take a look at what's going on right now across industry verticals. Where are people putting the most efforts to try to ramp up, their, development, to try to ramp up efficiencies, right? It is, in fact, AI. And so just having that in mind, and then you just doing just just basic searches on what AI is capable of doing and its implementations. This is just we're again the very beginning. So I'm very bullish on tech, and I would say, for some reason I have Trump in my mind right now saying build that wall. I don't want to get political or anything, but I saw a meme right before I jumped on here with that dance that he does. So this is probably why it's coming to mind. But in my mind, I'm like, buy. Do your own due diligence and research on what you're buying. But that's, generally speaking, what I see when it comes to tech. It's just like there's so much opportunity out there, man.
Yeah. And in terms of buy, just, being a consistent buyer of stocks, once again, that leads us to this final question that I have saved from Aaron. Can you dollar cost average the same amount each month, but buy selective stocks? So at first I read this and I thought, is he asking, can you dollar cost average just into individual companies no matter what they're doing? But now I'm thinking maybe it's a different question now that I'm reading it again. I think he's really asking, can you invest the same amount, but be selective with where you're buying? Do you have any thoughts on that?
That's what I thought that question was. You can be selective with where you're DCAing. And
Yeah.
I'll speak again. Dollar cost averaging was really meant more for like funds. Like the whole strategy behind it is like mutual funds and ETFs, and you're right, like just have a set fixed amount that doesn't ever change, and regardless of the state of the market, up or down, you're buying. However, you can mend and bend the rules however you'd like to. And that's the blessing of curating your own portfolio and having your own strategy. And so I would just say, as long as you're investing your capital into the market every week in high conviction opportunities, you can do whatever you want.
Yeah, absolutely. That's the beauty of being the CEO of your life, of your portfolios. You can make whatever capital allocation decisions you think are best. And I would say, like, as far as the question goes, can you invest the same amount but be selective with where you put it? I think when it comes to individual companies, I think that's exactly how you should be doing it. I often get the opposite question, which is kind of why I think I defaulted to reading it that way. I usually get the question, and I'm sure Ari does too, that's, can you dollar cost average into the same amount into companies, every single week or every single month, no matter the price? Like, there's people who want to know, can you invest $100 into Nvidia or Procter and Gamble, no matter what it's doing? Like, is that a good idea? And, on a similar note, I think, yeah, you can do that. But I think when it comes to individual companies and dollar cost averaging, there are good times to buy companies. There are bad times to buy companies. And I think this, obviously the same is true with ETFs, because they go up and down in price as well. But I think it's a bit easier to get away with dollar cost averaging the same amount into a fund, because the fund is comprised of so many different individual companies that are individually at their own different valuations and, good or bad buying price. But I think when it comes to just buying companies, you've got to be selective. And I think that's where you do need to time things a bit more. They say, timing the market versus timing the market. And that certainly does play a role. But I think there's undeniably good times to buy companies and bad times to buy companies.
Yeah, I totally agree with you. I do want to, just because I'm seeing it now in the chat, investing with Adam K. He's always with us on the lives. He's always with us each conversation, at least in the comments. So I do want to just quickly give him a shout out for that. But I also just want to tell you straight up, Adam, I think, for you have one too many stocks in that portfolio. So there would be like a multitude of companies that I would boot. Maybe that's hard to hear, but it's kind of, The more investors I speak to, and I've used to talk a lot about this, having 30, 40, 50 holdings. And, now I even go towards like, okay, now having like 20 to 30, just getting off the phone the other day with the hedge fund managers, the same thing, man, same conversation. It's like, if you sit and you really sit, it's kind of like I think it was Warren Buffett saying like, hey, all your bucket list, write down everything you want to do, and then go through that bucket list and circle like the top 5 things, and then realize you're like only ever going to do really those 5 things, right? Like those 5 bucket list things. I think that's basically when it comes down to investing. You can have a list of 20 stocks, 25 stocks, but it all goes back to Bill Ackman, me listening to Bill Ackman's advice, and Warren Buffett, really talking about high conviction plays and stuff. It's like, when you don't have millions and millions of millions of dollars, I say be very, very freaking selective. And I also think Warren Buffett spoke about that. He was given like a speech in front of a class, and he even said like, because I don't have, like, I didn't, if you don't have all the money in the world, right? Like he does now, like you have to think about Warren Buffett before he became Warren Buffett. I think that's really important, because people will always be like, oh yeah, but Buffett's got billions and he's doing all, but he didn't start there. Buffett didn't start with, dozens and dozens of companies. And so I think that's very important to really think about when you start to mention names like Buffett and the alike. But a lot of very successful investors were very, very selective in the beginning. And then as they amass their wealth, they continue to build out their portfolios.
Yeah, and I will say in Adam's defense, I think he's got I don't know the exact number, but I think he's got a pretty hefty portfolio. And also I know, Adam's background really is in trading, because he used to work at the Chicago Mercantile Exchange, right?
Yeah.
And
I had
so
Adam on my channel. He was
I remember that.
on Master of the Market. I love
And
Adam, but I'm just going to be frank. I think you got too many positions.
I think he comes by it naturally. I think there's a little bit of trading there in his nature. And I think when we're looking at, and Adam, I don't want to speak for you because I totally could be wrong, but I think maybe that's where some of these like Whirlpool come in, or even Starbucks, maybe Pfizer, Target for sure, Kraft Heinz perhaps. I think he's definitely buying stocks on the dip, thinking that maybe they're just, I don't want to say unnecessarily price low, but price considerably lower than their averages. So, just there will be some sort of mean reversion reaction to some of these. I don't know. I'm looking at those and that's kind of what I'm thinking, but I could totally be wrong on that.
Dude, Adam's got a big portfolio. Like he's not like, just nobody out there,
There you go.
Yeah, there we go. He's got a big portfolio. But I would just say, I think my personal take is I think if you double down on your higher conviction stocks, just like I would share this with anybody, like what are your highest conviction plays? And if you really have such high conviction in them and you took your money, doubled down on them, well, maybe that 3 would be 6 million. I don't know, but that's how I feel like. And that's also where I've seen, if I have to be honest, this last year with my portfolio, man, I feel like every few weeks I was like, Ryne, I'm going to be hitting this. I want to hit this. I want to hit that. Right. And I kept hitting it. The only thing I kept doing this whole year, though, is doubling down on higher conviction. Right. And it's worked out well, and what do you think 2026 is going to bring? Higher conviction. Right. So yes, your portfolio will be more volatile. That's for sure. Because you're going to have less, holdings in there to spread yourself out. But if they're high conviction picks and you know them inside and out, you really shouldn't have anything to worry about, in my opinion.
Man, if I had $3 million, I'd, 4% yield, $3 million, $120K. And
Ryne would buy 2 watches.
Dude, I'd buy 3 watches. I'd buy 2 watches and a pocket watch just for the heck of it.
Your daughter.
Exactly. Yeah, man. Someday it's fun to daydream. Oh, he says
Really?
Meta, Alphabet, and Amazon are 30+% of the portfolio.
Yeah.
Dang.
See, there you go. And I don't, again, I don't know that like where he started with I just think it's so important to build up those high conviction plays. But Adam, if that is the case, Meta, Google, Amazon are 30+% of the portfolio. That means that some of those stocks that you mentioned are like slivers. And then it's like, well, how much is really going to come in from them, you know?
Yeah. All right, we're about an hour and 5. Any last questions from you guys before we call it an episode? Ari, any last thoughts from you?
I want to be
Anything we're
bold
missing
and
here?
like tell people that I'm going to hit, some crazy number before 2026. But I'm going to refrain from giving a number and just say I hope to have one heck of a month to close out 2026. I'm very happy. I'm very satisfied with myself that we got over that $400,000 mark. I would really love if I can pull it off to get another 25 grand in there before the end of the year. That would be pretty absurd, but at this rate, who knows? Stay tuned. Ryne, I'll pass it back to you.
Yeah, I mean, I second that. Let's see what this next month brings. No matter what, I've got a good feeling about it. And whether it goes up, that's going to be good. Whether it goes down, that's going to be good too. It's going to set the stage to buy some more, create some more buying opportunities, and we all love that. But otherwise, that's about. Yeah, actually, last thing. I think next week, let's set a date. Next week for next week's episode, let's come into it with a date for our book club Zoom call. I think that should be our goal.
Already was in touch with Jill just before the weekend.
Nice. Okay.
So
Cool.
she's
And we'll talk about it
the
off
real
camera,
question
but
actually. Yeah, that was this is actually for everybody. The real question is, would it be better, to do this thing live, Ryne, or just pre-record and make sure we get everything out there? Because that's always the key. But we will try our best to accommodate what we think would be best for everybody. I'll put it that way.
yeah, we'll figure it out. I mean, off the top of my head, these live streams are fun, and it'll give the chat an opportunity to ask questions and chime in too. So maybe we try and shoot for that.
If that's the case, it may not be Saturday. So just keep your eyes out for a post from Ryne and I about when we are going to go live next, because it will be with Jill, the author of Retire Often.
Yeah. But before that, we've got to do a big like Zoom call with you guys, with the people that have read the book and want to take part. So I think we'll do that before chatting with the author, right? That's our plan.
Yeah. So the Zoom chat, and then we get the author, live here and answer questions and have a good conversation with her.
Yeah. So next week we'll come into the episode. We'll have a date set for the Zoom call, and we'll get that on the books.
Actually, you know what? I think because if we do that big Zoom room, we have to know how many people are out there who actually read the book and want to partake in the Zoom room.
Okay.
So we do have a deep end email address. Let's leave that email address in the comments pinned for everybody. And if you've read the book and you want to participate in the Zoom, then email us so we can get this all figured out.
Yeah, I just put it in the live chat here. Once the stream ends as well, and I go and switch up the thumbnail and title and stuff, I'll put the email in the comments as well. But yeah, you guys shoot us an email right there. It's the actually, I think I typed it wrong.
You're at the deep end.
Yeah, here, let me fix it. One sec. There. Okay. The deepend.listen@gmail.com. Shoot us an email there. Let us know that you want to join the book club, just so we, like Ari said, we can get a head count.
And with that, until next week, we will see you all in the next one.
All right, guys. Thank you.